Welcome back to part two of our investment and risk lesson. What we're covering today is the different types of investments that you may be interested in to save your money uh, for short or long term as we go. So, without any further ado, let's get into the assignment that we are working on. So, we started before by covering compound interest, and it's a really important concept for us to know and understand that as you're investing your money, compound interest allows over time for your money to double, and then for that amount to then double, and then for that another big amount to double, and it'll double faster and faster and faster as time goes on. That's why teaching you guys about this now means so much, because the more time you give your investments to double, the more times they will double. And that means your money can grow and grow faster and faster and faster. So we covered all these concepts in the first video, as well as some of the math and other percentages there. We also covered the big characteristics you need to consider when investing. We know that rate of return, just as a quick reminder, rate of return is the interest that you earn on your investment. So it's how much you get paid for your investments. Risk is how likely your investment is to pay off or not, typically something you want to reduce if possible. Liquidity is another good thing, that liquidity determines how quickly you can spend your investment, how quickly you can turn it into cash. And the fourth one is tax status, which is the rate and frequency to which an investment gets taxed. Remember, as your money grows, if the government keeps coming and pulling some out, that means it's going to grow a lot slower. And that means at the end of the time you want your money, you'll have a lot less. Because the earlier and more often the government takes money out, the less times that money can double. Okay, so we move on to our types of investments, which I've listed here in by ranking them from least risky to most risky. And the first three we're going to talk about is certain types of accounts that you can have at a bank. So the first thing to remember is bank accounts, as in money markets and CDs, are all things that you could probably get at your local bank. Now, a bank account, when I refer to that here, is I'm talking about like a savings account or even a checking account kind of essentially works here. All right, what that means is this. A bank account has several pros, and what you need to do in your pros and cons is write what is going on to those four factors: the rate of return, the risk, the liquidity, and the tax status. And you're going to want to put a little bit of commentary for each one. So one bit here is when we talk about bank accounts, we can start with the rate of return. The rate of return is a con because it's under 1%. So it definitely goes in the con categories, and it would take like 80 years for your money to double. That's a long time and not a really good place to invest money if you want to save it to retire in the long run. Now, risk is definitely a pro, as in your money is very safe in a bank, especially when we cover things like the FDIC. We learn that banks and FDIC insured accounts, not one of them has actually failed in over 80 years since the FDIC has been around. All right, as far as liquidity goes, that's another pro. You might want to put that your money is very liquid. How quickly can you spend money in your savings account? Well, the same day. You could transfer it out of your savings account right now, and in an hour or so, you could be spending it. But a final con for your regular bank account is its tax status. Remember, when you get paid your money from your paycheck, taxes get taken out of it in the payroll tax and your income taxes, which is going to be a very high rate. Then, as you earn interest, you'll have to pay the capital gains rate, which is a lower rate, but you'll have to do it every year. So what the big con for tax status would be is that it gets taxed. You pay your income tax and it's taxed annually. So it gets taxed every year. That's a big con. Okay, so that's your general bank account. A money market account is a different type of account because it's essentially you're giving the bank money and they're taking it and they're going to use it to loan it out to other banks. What it's able to do then is give you a higher interest rate. But that higher interest rate is probably going to be below 2%, which is what you should probably be writing there, like low interest rate, under 2%. That means it'll take maybe 40 years for your money to double. And that's a long time too. So clearly a con. A pro, though, is risk. They are not very risky. Banks are very stable. And when they guarantee you a 1.8% rate of return, that's what you're going to get. So the risk is very low. Liquidity, money market accounts are pretty liquid. You typically have to go to the bank and request your money, which means you could spend it the same day or at least by the next day. So you can get your money out pretty quick. One day is all it takes. So your money is pretty liquid. Definitely a pro. However, the tax status is just like a bank account. You're going to pay your income taxes on it, and it gets taxed every year. So that means money is going to be pulled out of it. And just the interest is what's going to get taxed after your initial deposit into a money market account. So your interest gets taxed every year. So it's might be less than 2%, but then you got to take out 17% of that, and it reduces your amount. All right, a CD or certificate of deposit. This is really important because it's probably what you guys should be investing in if you plan on saving for the short term. If you're planning on going to college in the next few months or even just the next year or two, a CD is one of the safest investments you can do that'll get you the highest interest rate. So short-term investments, typically you want to be a lot safer than long-term investments where you can absorb more risk over the long term. So a CD is where you give the bank a certain amount of money and you essentially promise to not touch it for a certain amount of time. There are things like 1 month CD, 3 months, 6, 9 month, year CDs, 18 month, 2-year CDs. I think I've even heard of a 3-year CD. So it's places that you, for whatever time period you agree upon, you promise not to touch it. Now, some of those longer CDs will pay you almost 3% interest. So that's better, but also 3% interest means your money won't double, for about 20 years. So that's a lot better, but I would still put the rate of return in a con and put it as under 3%. A pro is the risk again. Banks are pretty safe, and CDs are an agreement. So when you say, I want 3% interest, and they go, you get 3% interest, you're going to get 3% interest. There's no real fluctuations in it. One of the other pros, which is really tricky in this, is its liquidity. You could put that in pro or con because you kind of promise not to touch it. But if you got a 6-month CD and 2 months later, you're like, I want my money now, you can get it probably in a day. The problem is all the interest that you had built up to that point, you don't get it. So you have to forfeit your interest and take your money out early. So there's a bit of a penalty there. So it is liquid. And you can get all your money very quickly, but you do have to give up something to get it. So you can put pro or con there for liquidity. Its tax status, though, is definitely a con because with a CD's tax status, it's going to pay your income tax on it and also taxed every year, which means that's a lot of taxes you pay on your investment. Okay, so those are our 3 bank accounts, very standard things. And you guys probably have this, and maybe one day you're probably going to want to have a certificate of deposit. They're good for kind of short-term investments where you can at least get some interest. If you put $1,000 in, for a 3% rate of return, that means you got $30 by doing nothing. This is free $30 for putting your money in the bank. It's a pretty good deal. All right, now a certificate. The next one we'll move on to is a bond. And bonds are kind of tricky because there's many different types of bonds. You can have government bonds, you can have corporate bonds, and different risk amongst all the different types of government and corporate bonds. A state bond or a city bond, a municipal bond they call it, will pay you a higher interest rate than a treasury bond. And different corporations, some are very trustworthy and they'll definitely pay you back, and some aren't. Well, they have to pay you more interest. So I'll try to kind of cover those as we go, and you can see the pros and cons of bonds. And I'll focus mostly on U.S. government treasury bonds because they're very, very safe. So a pro of a bond is going to be its risk. Bonds, U.S. treasury bonds are very safe. Do keep in mind, junk bonds, very unsafe. They're from firms that tend to be guaranteed to fail or have a very difficult time paying you back. But for treasury bonds, a big pro is risk. U.S. Treasury has never defaulted on a single payment in its entire history. That's pretty safe. So 230 years of perfect credit. Ooh, 200. Wow. 239 years. Okay, so bonds are really good in that aspect. A con would be its rate of return. U.S. Treasury bonds rate of return is about 1%, sometimes a little bit higher, and it depends on the time frame of those. So they tend to have a lower rate of return, but you're giving up the rate of return for the reduced risk. Like municipal bonds, higher rates of return. Corporate bonds, even higher, because you take on more risk in those aspects. All right, furthering bonds, liquidity is a con for bonds. And that's because if you get a bond and it's a 5-year bond, you have to wait that 5 years before you can redeem it. If you go to the government and say, like, yeah, I know we said 5 years, but I want it back now, they're like, that's not how this works. Because remember, a bond is essentially an IOU. It's when the government gives you a sheet of paper, or you give the government money, they give you a sheet of paper saying, I owe you money, and I promise to pay you back this amount at this time with this much interest. So you can, in fairness, you can sell bonds to other people, but that market can be volatile and you can lose money or gain money that way too. But it's not very liquid. You have to wait until the agreed upon time to cash your bonds in. And a pro, though, for bonds is their tax status. So if I want to go a bond, I'm going to have to pay taxes on my original income. So I do pay the income tax rate, but then I'm going to pay the capital gains rate once I redeem the bond later, which the reason this is a pro is you're only getting taxed twice ever for the life of the bond. So if I got a 10-year bond, I pay taxes on that bond twice. So I put that in the pro category because that's a lot better than every year. All right, moving on to our next one. Our next concept is mutual funds. And what's good about mutual funds is we've already covered them as we're playing our stock market game. So a mutual fund, remember, is a collection of stocks, usually over 100 stocks that give you a well-diversified stock portfolio. It's usually run by a mutual fund manager, and an index fund is a type of mutual fund. And index funds, by the way, are probably something you want to look into if you're going to invest in mutual funds. So the major pro of a mutual fund is its rate of return. Mutual funds tend to have very high rates of return of 8 to 10% per year. So that means your money will double every, shall we say, 7 to 9 years. Okay, so 7 to 9 years, your money is going to double and then redouble and redouble again and redouble again by the time you retire. That's a much better deal. So mutual funds, the big pro for them is a higher rate of return. The con, though, is it's risky. In the first couple months of class, when we play stock market games, some of you guys were earning 25% on your mutual funds rates of return. And most of you guys have lost, if we did it per annum, like 80% rates of return, or negative 80% rate of return. You've lost about 30% of your investment in a few months. So the thing is, mutual funds are volatile. You can make money, but you can also lose money, and you're going to have to ride that wave. That's why they're a better long-term investment. So a con is mutual funds have much higher risk. On the other hand, mutual funds liquidity is a bit of a con. The reason is you could sell your mutual fund today in the markets and get your money. But if you tried to sell a mutual fund right now during a downtime, you're not going to get all your money back. So you have to wait as the market fluctuates from day to day and try to time it where your mutual fund is at a higher value. If you're able to do that, you have a really good chance of getting all your money back. The problem is that could take days, weeks, maybe even a year to get it more of an upswing. So its liquidity is questionable. Sometimes it can be good if you're lucky in your timing. Sometimes it can be bad. So a big con is liquidity. A pro, again, is tax status. If I were to buy a mutual fund, that means that income I'm going to spend has already been paid the income tax on it. And then whatever interest or profit I make from my mutual funds when I sell it, that is then going to be taxed at the capital gains rate. And that means you want to write down it's taxed twice ever. So it only gets taxed 2 times ever, at the income rate and the capital gains rate. So it's a much better focus there. All right, so that's mutual funds. Growth stocks, on the other hand, are one of the simplest concepts you know, because it's any stock that you hope will grow. So you can think of stock in Apple, Nike, Walmart, Monsanto, Chase Bank. All those are stocks in those companies, and you hope the stock value will grow and you can make money. So a big pro of growth stocks can be the rate of return. Many stocks can grow, and some can grow very, very fast at like 30, 40, 50%. I would say like maybe 15% would be a good growth stock rate of return. However, the con that goes along with it is that these stocks tend to also lose money quickly too. There's very high risk that you can buy a stock and it takes off, but there's also another stock just tanking at the same time and you can lose a lot of money. So it's high rate of return, but high risk. As far as liquidity goes, you have the same problem with mutual funds, that you can sell a stock on any weekday when the market's open and get your money. But if your timing's not good, you could be trying to sell it while it's going down, and you might have to wait, days, weeks, months to try to sell that stock at a more valuable price to get all your money back. So liquidity would be a bit of a con, but another pro would be the tax status. Stocks, like mutual funds, are taxed twice ever. One with the income tax, and then again at the end of it when you sell it at the capital gains rate. So those are our standard investments that we've kind of covered and that you know about. Other investments that I haven't covered here would be things like precious metals that I used to have on this assignment. And just one thing to know about precious metals is they're very volatile. You hear people talk about it all the time, like gold always goes up, or it's such a great safe value. Gold does go up in value, but it can also tank in value. And I've seen that a lot in the last 12 years when we had the recession and gold values were going up and you saw like cash for gold stores everywhere. But if you look at the price of gold now, it went from $18,000 to like $900 an ounce, which means you don't see those stores because it tanked so much. So gold, silver, and platinum, they go up and down all the time, usually without warning. And so they're kind of risky investments where they're volatile. You can make a lot of money, you can also lose some with them. Okay, housing is kind of a special investment because it doesn't work the same as all these others. So a pro into housing, particularly a house that you might want to buy, would be that you get to live in it. So one is, instead of like the house that I bought, I get to live in my house while I buy it. Remember, I don't own my house. I owe money on my house, which means the bank is what owns my house. So instead of me spending 20 years trying to buy the house before it's mine and I can move into it, I get to move into the house and pay it off as I go. Which means that instead of me paying rent and trying to buy a house, I just buy the house, and instead of rent, I pay my mortgage, which is me buying the house. So my money kind of pays my rent and is purchasing the house. So that's really nice that it eliminates my rent costs because it's all going to the mortgage. It's forcing me to invest in my future because one day I'll be able to sell this house and I'll get money back that I can use to retire. Or when I'm old enough, I can keep my house, and once my mortgage is paid off, I can just go ahead and live essentially rent-free because I'm not having to pay rent for the house. Okay, so that's a big pro. The second part, houses do tend to increase in value, but they can decrease in value, as we learned during the Great Recession. Some houses, especially in areas you guys live in, Hillsborough County, they decreased 50%. So some people lost a lot of money in their houses. So the cons to housing are also pretty big too. One, you have to pay taxes every year on your house and property taxes. So I have to pay over $2,000 every year in property taxes. I then need to pay $2,400 every year in insurance. So I need to pay taxes and insurance that I essentially am not, getting money back on unless I need to make a claim on the insurance. So the tax status on housing is pretty high. You have to pay a lot in taxes every single year. Another con in taxes for housing is maintenance. I can't just buy a house, do nothing, and say, give me money later. I need to fix it. Every 10, 15 years, I need to put a new roof on it, and that can cost you $10,000 to $25,000. You also need to go ahead and make sure that you guys, another con for housing. So we have taxes, we have maintenance, and also it's not liquid at all. If I wanted to sell my house and I needed cash now, it would take months and months to sell my house. And every time you buy or sell a house, you can lose like $8,000, $8 to $10,000 in fees and real estate agents and just losses from the transaction of getting a new loan and all that. So every time you're buying and selling a house, I think that's like $8,000 to $10,000 just gone from your investment that you're going to have to make up. And if you try to sell it again, you can lose that again. So housing, it's very illiquid. It's very difficult to sell and turn into cash. You can't do that quickly. But that does not mean housing is just a bad investment. I know there are lots of cons and not many pros, but the pro is a pretty big one. Everyone has to pay rent. So instead of paying rent, you can pay a mortgage and you buy the house you live in. So it's a great way for a lot of people to invest, especially if they don't have a lot of disposable income, to invest in a retirement account like a 401k or IRA, which is what we're covering next. The key to using housing as an investment tool does deal with all kinds of things of like age of house, maintenance costs, and location, and how good the market's going to do, or is that a good neighborhood? Yeah, that all plays there, but I'm not trying to get into those weeds. The key to making housing work is if you're going to stay in it and own it for a long time. That huge loss you get right when you buy a house and have to pay thousands of dollars in kind of fees and costs, it takes a lot of time to get that up. And keep in mind, you have to put a big down payment in. I had to make a $46,000 down payment on my house. Well, that $46,000 was invested in earning me interest. Well, now that it's in my house, it's not earning me any interest. It's just in my house. So the key is, as time goes on and I buy more of my house and I owe less, and that big upfront cost of all the fees gets spread out, it's going to take me 7 to 9 years to have my house actually be financially beneficial to me. So it's one thing to think of is housing's a great idea, but it's specifically if you plan on staying in it. If you plan on moving somewhere every 2-3 years, buying housing tends to not pay off as well. And I have a bunch of things we could have done to show you, and some spreadsheets and other things that kind of take numbers into account that a lot of people don't consider, because that opportunity cost. If I rent, I can save all that money up and gain interest on it. But if I buy, I take that money I saved and I put in down payment, and I'm not saving. So housing works if you plan to live there a long time. It can be a very good investment. So just kind of keep that one aspect. But if you're going to move a lot, better to rent than buy and just save money up on the side. Okay, the last one we have here is 401ks and IRAs. What a 401k and IRA are retirement accounts. They're special retirement accounts that can be created through your business or a private investment bank. So let's go over the difference of a 401k and IRA. The difference is a 401k is through your employer, where an IRA stands for individual retirement account. And what that means is you can get one at almost any financial institution. So you can go to your bank and say, I'd like to buy an IRA. And they'll be like, well, let's get you to our finance specialist. There's all kinds of other ways you can buy IRA through firms like Edward Jones and other financial planning firms. So the difference is 401ks come from your job. IRAs are kind of personal and individual from a financial institution. So that's a difference between the two. Now, the pros for these are pretty lengthy. So one, in a 401k and an IRA, your money will be put aside, and they'll take your money and invest in many, like dozens of mutual funds, a few growth stocks to kind of add a little risk. They'll put your money in bonds and gold, which are a good kind of recession-proofing backup. So if the market tanks, you have something kind of cushion your blow. And they'll use something called financial portfolio theory to get you a well-diversified, balanced account that has been proven to reduce risk but increase returns for its investors. So you don't have to go, I want that one, but that, but not that, but that. You don't have to do a lot of choosing. Your financial planner who will walk you through all this will get all your money moving for you. And you do have some options of how big of a risk you kind of want to take, or that, this or that. Now, 403Bs are something you'll hear about. That's for government employees. So I have 403Bs because I work for the government. It works just like an IRA. So they're very similar things. So if you hear someone going like, oh, you have 403B versus IRA, they work the same way. And most of you have jobs. If you work for a job with any big firm, if you work at McDonald's or Publix or Dunkin' Donuts, those places offer 401ks. You just need to go to your manager and say, hey, I'd like to start putting my money in a 401k now. And they'll go like, oh, here's a paperwork, or here's a guy to call. And it doesn't take long at all. And they start working. Now, 401k and a standard IRA both work this way. The key to their major, so the pros are they have high rates of return. And the other major pro is their tax status. That's what makes them so unique and so useful, because they only get taxed once ever. What they do with a 401k is you ask your job, hey, I want to put money in a 401k. Like, how much? You're like, $500 a month. Okay, cool. That means they take $500 out of what they owe you and put it in a 401k and then pay you the rest. What that does is they take money out of, essentially out of your paycheck before you get paid and before that check gets taxed. So instead of paying taxes on that income up front, that money gets invested, and all that money that would have gone to the government is now working for you, and it's going to grow and double and earn you money as you go. When you're done and ready to retire and pull your money out of your 401k, you just pay taxes once at the end at the much lower capital gains rate. So a 401k and IRA will put your money right into your bank account before taxes are invested into it. And so remember that taxes is now money making you money. And it's a really useful thing to have in there to get you rich. There's another thing called a Roth IRA, which flips a little different. It's if money's already paid income tax on it, you can take that money, put it into a Roth IRA. And since you pay taxes up front, you don't get taxed ever again. It's still taxed just one time. So that's essentially how they work. They have great tax status that allows you to earn money off the money that you would have been paying tax up front just to pay taxes later at a much lower rate. That's why they're really good. One of their cons, though, is they're for long-term investments. You really can't touch a 401k or IRA until you retire. Now, there are kinds of, and if you have a 401k now, if you had a 401k because you worked at McDonald's, if you moved and got a different job, you can move your 401k and merge it in with that account. So you can either have two 401ks or you can merge them into one, probably the best thing, and then just have one 401k with all the money from one added to the other. So that's essentially how these things work with 401ks and IRAs. I strongly recommend that you look into 401ks and IRAs, because if you're wondering, hey, what do most people retire to? The answer is 401ks and IRAs. And they do this because they're one of the best options out there for investing, period, because they have that special tax status that the government gives them. So make sure you're looking into your 401ks. And remember, you can start now if you have a job. And if you don't have a job and have a lot of money lying around, you can buy a Roth IRA and you've already paid taxes, so you never have to do that again. So that's our 401k and IRA, and those are different types of investment that you should be aware of. I hope you guys understood this, and I hope this helps you guys out in the future. You guys are smart with your money. Okay, good luck, everyone. And we have one more assignment to do. Look forward to giving it to you real soon.